to the Money RX for CRNAs podcast, where you go behind the scenes with host Brett Fellows, CFP, as he explores the unique opportunities and challenges facing certified registered nurse anesthetists along the path to financial independence. In each episode, Brett shares expert insights and actionable advice, equipping you with the tools you need to take control of your financial destiny and retire on your terms. And now, here's your host, Brett Fellows.
Welcome to the Money RX for CRNAs podcast. Thank you for joining us. I'm your host, Brett Fellows, a certified financial planner with over 20 years of experience in guiding CRNAs through the complexities of financial planning, tax strategies, and investment management. For those of you who have tuned in before, welcome back. And for anyone who is listening for the first time, this podcast is dedicated to helping certified registered nurse anesthetists achieve financial independence and retire on their own terms. So, in today's Money RX for CRNAs episode, we're talking about retirement planning and offering some insights and guidance to help you achieve the financial security you need during your retirement years. As always, thank you for joining us. Our primary audience is CRNAs around the age of 50, often married with children, and typically about 10 years away from retirement. You've worked hard, and now it's time to ensure that your money works hard for you. If you want to receive weekly updates with recaps of the show or resources that we mention on the show, as well as some exclusive content, sign up for our Friday Blitz email, and you can do that at oakcapitaladvisor.com. And that way, once a week, you'll get an email with a recap of everything and some links to the stuff we talk about. And with that out of the way, let's get started on your journey to making work optional on your own terms and answering the question, how much do you really need? But really, how much will your retirement cost? MoneyWeek magazine recently put out a study that the cost of a comfortable retirement has increased from $37,300 to $43,100 for a single person, and from $59,000 to $72,000 for a couple annually. Now, this includes expenses like groceries, meals, and leisure type of activities. And Kiplinger put out an article in April that Americans now believe that they need nearly 1.5 million to retire comfortably. And this is a significant increase from the previous years. And this estimate, too, considers factors like inflation and rising living costs. But do these numbers match up? Well, if Americans think that they need 1.5 million nest egg to retire comfortably from the Kiplinger article, well, then we can use the most common benchmark that we hear when it comes to retirement planning, the 4% rule. Now, this means that you can sustain withdrawing 4% inflation adjusted from your assets with not too much fear of ever running out of money. So if I have a nest egg of 1.5 million, I could distribute 4% or $60,000 each year, which is a pretty realistic number. But more importantly, this is a great benchmark. It's really good when you're a long way away from retiring, and it's good to shoot for. And I think that's very important. But as you get closer to retirement, maybe you're within 5 years from retirement, this type of 4% benchmark becomes much less meaningful. So, in order to get to a place where you have confidence in your retirement-focused efforts, it's actually much more important that you go through your own process so that you can organize this and focus on the right things. So before we can figure out how much money we need for retirement, we must first answer the question, What do you want to do? Okay, so now you've been good and you know how much you spend compared to how much you make. In other words, you have a working budget. Now, as you look ahead to retirement, you should create the same snapshot for then. Let's call this your base great life. This means projecting how much cash flow you will have from your investments and retirement accounts and comparing that to what you expect to spend on the lifestyle you envision. Because retirement should be your time, the time when you can do things and go places that you've dreamt of. Once you've drawn up a projected type of budget, you will know how you may be able to reach those goals. It could be that you have more than enough assets to fill your plans, but you may also discover that those assets come up a little short. But at least then you can adjust your plans or adjust your income by continuing to work. So the best way to get started with this is just to look back at your last 6 months of your checking and credit card statements. And on average, what do you need to spend every single month to live your base great life? And I prefer to use this type of method at the very beginning of this process because we don't want to get too bogged down in the details. We can refine these as we go along. Make sense? And if you need any help with this, I put in the show notes a link to a checklist that we give to our clients that covers 32 of the most important planning issues to identify and consider for a client who's about to retire. So go ahead and download that from our show notes if you think it would help. After you look at your base great life, if you have bucket list ideas, write down each item and an estimated cost of those. Use this to figure out the best way to reach each goal. Be realistic and prioritize those achievements. Which ones should you do while you're still in your prime health, and which can be done when you're a bit older? But think of your bucket list as your life's highlight reel, prioritizing those highlights that bring the most joy and fulfillment to you. Maybe you want to help your grandchildren with college. Well, this probably means establishing some 529 plans because these offer some tax advantages which your financial professional can explain, and they've become much more flexible in the educational uses space where they can be applied to, and beneficiaries can also be changed. Now, education is wonderful, but you also might want to leave something for your family. And there are many ways to do this, but first and foremost, you need an estate plan to set it all down in black and white. Now, an attorney and a financial professional can help here too. Along with a will and powers of attorney, you can write a letter of instruction outlining exactly how you wish your assets to be distributed. Now, this includes any jewelry or collectibles you have, as well as vintage photographs of aunts and uncles in the old country. And I think discussing budgeting and goal setting for retirement is the fun part, and definitely where everyone should start. But we also have to turn our attention to a critical area that can significantly impact your financial security in retirement: long-term care. Now, no one knows exactly how long they will live or their state of health. And it's no secret that healthcare costs continue to rise, and nursing home care is no exception. You may have saved well, but your stay at a nursing facility can wipe out you or your spouse's nest eggs and any assets you plan to leave to your children or grandchildren. Long-term care insurance can help ease this burden, but don't kid yourself, this is not cheap. But the sooner you get it, the less bitter the financial bite. You can also always choose to not get the coverage, but then you had better plan to have enough assets to self-insure, which means covering the costs yourself. To give you an analogy of what long-term care insurance actually is, think of it as a safety net for your retirement monies. Just like disability insurance is a safety net for your working income. Without it, one unexpected health issue could send you plummeting, taking your hard-earned savings with you. On the other hand, securing this insurance early on is like setting up a strong, reliable net that will catch you if you fall, ensuring your financial stability and retirement remains intact. So it's very important to have a conversation with your financial planner about the different types of long-term care policies available, because some plans have more flexibility than others, such as home care options, which might be more appealing if you prefer to stay in your own home as long as possible. Additionally, some newer policies combine life insurance with long-term care coverage, providing a death benefit if you don't end up using the long-term care benefits. This hybrid type of approach might be worth considering as part of your overall retirement strategy. So let's get back to the numbers. Let's assume for your base grade life that you spend $10,000 a month. Okay, so that means you're going to spend $120,000 a year net of taxes. And you're going to assume that you need that every single year from the time that you retire until the time that you and your spouse pass. And that will be adjusted for inflation, and taxes will be calculated in the background. Well, now that we know you have a base case great life, I like to then add the healthcare portion on top of that. So let's say an additional $10,000 a year for healthcare. So it's $130,000 a year for the rest of both of your lives. Well, now we have a number, and this is version number 1, because this will change as your life moves on. But from here, we can next add on to this, on top of this base case, some of those bucket items we just talked about. Let's say one of them is travel, and you think that travel is going to cost you $12,000 a year, and you're going to do that for 15 years. Maybe you're going to gift to your children. So you're going to have to stack these bucket item lists on top of your base great life. So now that you've got your spending part mapped out, you then have to figure out, how are we going to pay for this? Well, the first source for most CRNAs will be Social Security. Social Security is a podcast unto itself. This is a benefit that was never intended to cover all of the costs of retirement by itself. Unfortunately, there are people who are in their 60s and have not saved anything for retirement because they believe that Social Security will do it all. And that's wrong. You can take Social Security as early as age 62, but you will receive a smaller benefit. If you wait until your full retirement age, which can be found on the Social Security Administration's website, your benefits will be longer. And if you wait until the age of 70 to claim, your benefits will be larger still. There is no increase after age 70. There are too many exceptions to go through here, but among the rules for claiming benefits, there are special cases for spousal claims, those who have lost a spouse, children who have lost a parent, people with disabilities, and more. So you're definitely going to want to consult a Social Security specialist or a financial professional to make sure you do this correctly, because there is no do-over. Once you make your benefits choice, that is it. Now, to further complicate things, legislative changes can alter Social Security benefits and rules, so staying informed is crucial. So regularly reviewing your Social Security statement and understanding how your benefits integrate with your overall retirement plan can make a significant difference. Also, consider the tax implications of Social Security benefits, as up to 85% of your benefits may be taxable depending on your combined income. So again, discussing these aspects with a financial planner can help you optimize your strategy and ensure you're making the most informed decisions for your unique situation. Back to the numbers, the Social Security Administration says that the average American couple receives $3,800 a month or $50,000 per year. So, back to our example, if you needed $130,000 for your base rate life and $50,000 is going to be covered by Social Security, both inflation adjusted, then we still don't have $80,000 covered by any income. And so that's what we call our wealth gap. So the next resource that you have is your financial capital. And this is what we think of when we think of our 401k, 403b, Roth IRA, savings, etc. This is the money that has to fill the gap that our Social Security does not cover. And this is where you harvest all that you have saved. And then the last thing you're going to want to factor in is, are there any extraordinary things in life that are going to come into you? And inheritance is a common one. If you think you're going to get $200,000 in 5 years from your great aunt, well, then we'd want to count that inflow accordingly, because that definitely can help. So we now know the value of our financial capital. Next, we need to realistically use a figure for how much we think our financial capital will grow or not every year. Remember, at the very least, we need to keep pace with inflation. So again, talking about the rate of return is yet another podcast unto itself with a retirement portfolio. But for today, let's just fuse the figure of 5%. If my retirement capital grew at 5% each and every year, well, when you plug all of these things in, guess what? It's going to tell us one of two things. And this is one binary question we all have to answer. You're going to outlive your money, meaning you don't have enough, or your money is going to outlive you, meaning you have enough. But even if it tells you that you don't have enough, and honestly, that's where most of our clients fall in their first run through this, and that's okay. Because now you've established a foundation to make different kinds of decisions. Like, should I save more in tax-deferred accounts? Or what if we moved to a different state with lower taxes? What if we downsize? All of these types of decisions we can use to see if our results improve. Most importantly, you'll be creating confidence that you're not on any fool's journey about what your retirement is going to cost, or if it has any chance of being sustainable. And this also helps you, if you're within 5 years of wanting to retire, answer the question, should I save more now, or should I just enjoy life more now? Because you can create different scenarios to solve what's most important to you. So I hope it's clear to you that retirement planning requires careful consideration and a proactive approach. The journey to financial independence and a comfortable retirement involves more than just saving money. It demands from you a comprehensive strategy that aligns your unique goals and circumstances. So from understanding your future expenses and projecting your retirement income to exploring options like long-term care insurance and optimizing your Social Security benefits, each element plays a critical role in shaping your retirement landscape. Remember, that 1.5 million retirement savings goal we discussed is a guideline, not a one-size-fits-all solution. Your retirement plan should be as unique as your aspirations and your lifestyle. By setting realistic goals and prioritizing your spending and staying informed about financial trends and legislative changes, you can build a robust retirement strategy. So I'll say this again, engage with your financial planner regularly to adjust your plans as needed and ensure that your retirement vision becomes a reality. To change gears for a minute, I want to try out a new segment for you, and I'm thinking about calling it Anesthesia Anecdotes, where I want to talk about some tips about how to be happy that I'm actually trying to do for myself, that will hopefully resonate with you on a personal level. Because I know thinking about money and retirement can be a pretty heavy and stressful topic. Trust me, I do this every day. And how we are with money really depends much more on how we behave than what we know. So, the first thing that I'll share is something that I've been doing somewhat religiously now for almost 10 years. And that is using a book called The 5-Minute Journal every day. And I'll put a link to it in the show notes. What I love about it and how I use it in a couple of ways. Every day, it has me write out 3 things that I'm grateful for. Now, this idea of gratitude isn't a new concept, but what I like about this tool is that because I actually have to write it down, it definitely makes me stop and think about who or what am I grateful for. And if I happen to not have anyone or anything top of mind, it really helps me think about maybe someone I haven't thought about in a long time. And I've probably rekindled more somewhat friendly relationships with people simply by doing this one exercise. The second thing it prompts me is to write out 3 things I hope to accomplish today. Now, it's really easy for me to fall into the trap of only writing work tasks here. So I definitely try to include at least one personal action item that I can do that will make me feel good or feel as if I've accomplished something. And the last section, now this can be done at night before you go to bed, but I actually use it in the next morning, so I only have to open the book once per day, is to write down 3 great things that happened on that day. Often, if I've accomplished the 3 things that I said I wanted to, I'll simply write those in. But what's actually more fun is being present enough to notice the surprises or things I didn't see coming that were really great and happened on their own. And so that's how I use the 5-minute journal. And again, I put a link to it in the show notes if you're interested. So thank you for taking the time to learn more about financial planning with us today on the Money RX for CRNAs podcast. If you know a CRNA who needs financial planning guidance and think this would help them, click the share button and send it to them directly. Also, to make sure you continue to receive my content, make sure to click the subscribe button below. If you or a loved one needs some help or guidance with regards to knowing how much you need to save for retirement, or if you're simply interested in learning more about our practice, please reach out by emailing me directly at brett@oakcapitaladvisor.com or visiting our website, oakcapitaladvisor.com. On our website, you'll find tons of valuable information on a wide range of financial topics, because after all, our goal is to educate, inform, and be top of mind if and when questions for you come up. We're looking forward to working with CRNAs who understand you shouldn't be doing it alone, and you don't have to. And join me for our next show where I'm going to explore the topic of retirement again, but this time with a strong focus on how to plan your distributions for retirement. This episode has a lot to cover. You won't want to miss it. So until next time, have a great day.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.